Schedule 1A, no tax on car loan interest. This is one of the four provisions that fall on Schedule 1A. It's a new schedule for the tax year 2025, and it's part of the One Big Beautiful Bill Act. This is something encouraging the purchase of new vehicles, but it has to be a qualified car loan interest, and we'll define what that is. There's a couple of caveats. One, it has to be a new car, and the final assembly has to be in the U.S. We'll get into those details in a minute. But this comes in on part 4. That's page 2 of the Schedule 1A. It all starts with, is someone eligible? The amount has to be calculated for modified AGI to determine if they're subject to the phase out, where they fall into that definition. For most people, it's going to be their adjusted gross income because they won't have any adjustments to make. However, if someone did take the foreign earned income exclusion under Code Section 911, that's an add back to get to modified adjusted gross income. The same add back calculation is required if someone has provisions under U.S. taxation of an American Samoa resident under Code Section 931, or exclusions for bona fide residents of Puerto Rico in Code Section 933. Most taxpayers don't fall into that category, so for most, it will be their adjusted gross income. You start with AGI in line 1, you make the adjustments as necessary to get to line 3. This line 3 amount is used throughout this schedule for all 4 parts on the Schedule 1A. The part that we're talking about here is on page 2, it's part 4. So on line 25, you'll see enter that modified AGI amount. That will determine the calculation on whether the phase out is going to kick in for the taxpayer. So there's no tax on car loan interest. This is a temporary deduction. So for 2025 through 28, it's valid if you purchase and finance a new car. The deduction itself is limited to $10,000 of the interest paid. If someone pays less, maybe I financed a new car and only paid $7,000, the most I would get obviously would be $7,000, and then I'd still be subject to the phase out if my income was too high. Here's what we're talking about for those thresholds. If I'm single or head of household, my modified AGI threshold begins to reduce that deduction when it hits $100,000. It's double that for married filing joint at $200,000. There is a phase out range of $50,000, so it's fully phased out at $150,000 for most taxpayers, married filing joint $250,000. Now, the debt itself, this is where it gets kind of tricky because they didn't pass this bill until July 4th of 2025. They made it retroactive. So if I bought a brand new vehicle and financed that in February of 25, that interest would in fact be eligible because it's a new car secured by that first loan on that vehicle. So it has to be a brand new vehicle. The original use must begin with the taxpayer. This is a situation where I've seen this happen before with the electric vehicle credits, where it had to be a new vehicle. If it's titled, let's say someone bought the car and they financed it. They were home for basically 2 days. Maybe they drove 12 miles. The car's got less than 20 miles on the vehicle. He takes it back and said, I don't like this. I want to go a different route. Someone else comes and buys that vehicle. The title has to be original to that owner to qualify. So the second person that buys that vehicle off the lot, maybe it has less than 30 miles on it, but it's not brand new technically. And that's why there's a requirement that you report the VIN when you're filing this tax return. To be eligible, it's not for the big gas guzzlers that's out there. The gross vehicle weight has to be under 14,000 pounds. Now, it has to be a car, minivan, SUV, pickup truck, or two-wheeled vehicle. Motorcycles would qualify. So the good people at Harley-Davidson are probably pleased that this will be eligible. I've had some other people ask me, what about a golf cart or a UTV, where some people say that they're street legal because they have directional signals, they have a mirror so you can see people on your blind spots. Yes, they're street legal, but the primary purpose of a golf cart perhaps is recreation. It's not for use on a highway, so they do not qualify. It has to be a regular car, pickup SUV under 14,000 pounds. Another key requirement here, it has to be domestic assembly, which means that the final assembly of the vehicle has to happen in the United States. A lot of bills have provisions to basically encourage jobs or job creation in the United States. So they don't have to make all the parts or whatnot, but the final assembly has to be here in the US. So, how is someone supposed to know that? Well, that's why there's a requirement that the VIN is reported to claim that deduction. They're going to take a look at one, was this VIN ever registered under someone else's name? And two, is it assembled, final assembly now in the United States? That's a big difference. Well, you can look that up. There's two ways that you can do that. One, it should be indicated on the window sticker when someone buys this new vehicle. Most people don't save that, but you can look it up. Um, there's a 17-digit VIN that everyone has. If it starts with a 1, 4, or 5, then it was assembled in the US. So here's an example of a VIN number. That 1 at the beginning signifies the vehicle was, in fact, eligible because it was assembled in the United States. How can you look up your vehicle? Well, there is a decoder at this particular website for the National Highway Transportation Safety Administration, where you can find out where the vehicle was manufactured. This is what the website looks like. You can see that the part that's highlighted here is this VIN decoder, so you can take a look at where that vehicle was assembled. And in this particular situation, you scroll down to the bottom and you can see that this one was, it gives you the make, model, and the vehicle was assembled in the United States. So that information is available on the internet. The government has a way of tracking that as well. Remember, that first digit will tell everything that they need to know on whether it's an eligible vehicle or not. So don't try to file the tax return without it. That VIN has to be reported on the return. So this plant information, it was actually assembled in Lansing, Michigan. So that additional information is all tied in to that decoder website. Now, the new provision requires lenders file information returns for that interest that's received. So a special statement's supposed to come out for this first year. There's kind of an exception. What's going to happen in 2026 is it should show up on a 1098 VLI for vehicle loan interest, and it basically gives the vehicle loan interest amount that's received, the make, the model, the VIN number, everything that you need should be on that tax return. So the Form 1098 VLI, that is something that we're going to have in 2026. They did come out with a notice at the end of 2025 giving some relief. Taxpayers can rely on any information that the lender provided, even if they don't receive that 1098 VLI. So for what it's worth, this is going to be a year where you're going to have to document everything because they don't have that particular statement available. So how does it work mathematically? We take a married couple that are married filing joint. They pay $12,000 in qualified car loan interest. Their modified AGI for the year, $230,000. Well, they have an excess, and that excess is $30,000. When we do the math, that basically is a reduction to this subtraction of $6,000. And look what we're taking the deduction from. If we go back to the example here, they paid $12,000 in qualified interest, but we're subtracting the 6, the reduction itself, from the maximum $10,000, not the 12 what they actually paid. So the $4,000 is the final deduction amount, and that's what they get to claim on the Schedule 1A. So this is what that schedule looks like. You can see in line 22, line A, you've got the VIN that's listed there. And the most we can put down is the interest paid is $10,000, even though they paid 12. So in this situation, the haircut's going to reduce that deduction down to $4,000 once we give it the $6,000 haircut. So the math is there to make sure that it phases out for high income taxpayers. For more information on tax updates, go to our website at btb.tax. We've got free monthly newsletter, textbooks if you missed one of our prior sessions, seminars and webinars for upcoming events. Take a look at the title. Feel free to register or to check out the brochure on the webpage for additional information.